Hello, everyone. This is the East Coast Economic Update for November the 16th, 2009. This is going to be kind of short, but I want to just throw something out to everyone. I'm going to have in the more info box a chart that you can check periodically of the Baltic Dry Index. And Baltic Dry Index, if you don't know what it is, it is the index in which dried capacity like iron ore, oil, clothing, shoes, and whatever travels from China to the United States and back. And if you look at the 2 year chart from its high from 2007 till now, the Baltic Dry Index is down 62%. Why am I telling you this? Because China's productivity is up. Now, technically speaking, if China, and also because of that, the market is up to a certain degree. Now, I just wanted to point out to you that if that was beneficial to us, that China's productivity was increasing by 10%, the Baltic Dry Index would have responded in kind, and we would have been up over those 2 years, either at zero or up from where we had hit on our peak. This is not the case. We're down by 62%. So, so what it's telling me, and should be telling you, is that the Chinese are selling to their own domestic market, which means that we're in the presence of decoupling, which, if the Dow keeps going up, gold keeps going up, and the dollar keeps going down, that means that we're most likely no longer in a deflationary depression, but now entering a hyperinflationary one. This could change. It's early on. We'll know. I think if gold hits $1,300, it's well on its way to probably $1,200. And the dollar is dropping dramatically. It's in the low 74 bips, and this is just an indication. Whenever you see the markets go up, the dollar go down, gold go up, and the Baltic Dry Index pretty much go flat to down, it's an indication that we're in the midst of hyperinflation. But I just wanted to throw that Baltic Dry Index with you because you can watch it, you can check it back and forth, and see. But if you need to be looking at it at the 2 year mark, because the 2 year mark is at its peak where both our not our productivity, but in which we were producing the most, we were buying and consuming the most at that period, that peak, just before December 2007, in which it started to drop. If that continues to stay down, or even drop farther, it is a good sign, barring the mainstream media, that the decoupling not only of China but of India and the rest of Europe has occurred. In case anybody was not sure. So I just wanted to throw that out to you. It's a tool. It's a tool I use. Besides, I'm also going to have the dollar index, which I also look daily at, and the Kitco gold market. There's a lot of holdback on silver. Just want to throw that out off the top of my head. It's right now around $18. In reality, if you base it over the lifetime between gold and silver, silver should be, because gold being so close to $1,200, silver should be near $35 an ounce, or around that point. What's holding it down, I have no idea. I'll be straight with you, I don't know. But if that kicks back up, even if it hits into the 2025 mark, that's also an indication that probably things are gearing up for a hyperinflationary situation. Like I said, it's early. Things can change. And the only two choices really what we have right now is a deflationary depression or a hyperinflationary depression. So that's really not two choices that are good and bad. It's bad and worse. Deflationary, at least your dollar has some worth inside the country as well as outside the country. Hyperinflationary, we're talking Weimar Germany. So just wanted to share that with the group. So I left those three items for you to use. This is what I'm looking at as tools to tell me what's going on. And I just wanted to share with the group. So, all right, guys. Till further notice, peace.